Let's start this video by examining the US dollar index or ticker symbol DXY. Based on our analysis, we believe that wave 5 of a smaller degree, which is part of wave 1, has been completed. Currently, the DXY has been undergoing an upward correction, and it appears that wave 2 has likely concluded. Our expectation is for an impulsive downward movement towards wave 3. The next developments are intriguing because when we consider the larger picture, this entire pattern could be a part of a significant ABCDE structure. This implies that the DXY may potentially rebound from the horizontal trend line and make a final upward move towards wave E. However, if this scenario does not materialize, we can expect the dollar index to continue its descent towards wave 3. To confirm what lies ahead, we need to observe whether the horizontal trend line provides support or if it is breached. Based on my analysis, if the DXY crosses below the 50-day moving average, it would indicate a complete downtrend in the long and intermediate term. This situation could offer an advantage to sellers of the DXY, considering that various indicators suggest a bearish outlook. The MACD has already signaled a sell on the monthly chart, and we are also witnessing a loss of momentum on the weekly chart. Nevertheless, we should not disregard the possibility of an ABCDE pattern. In general, a weaker dollar has been providing support for equities and cryptocurrencies. However, the dollar index is not the sole factor influencing these asset classes. The Treasury yields also play a crucial role. It is worth noting that a declining dollar and lower yields are the most favorable combination. Conversely, if the dollar is falling alongside rising yields, it could signal potential challenges. Now let's shift our focus to the technical analysis of the 10-year Treasury yields. According to the technicals, wave 4 of a smaller degree has been completed, and we are currently progressing towards wave 5. We are observing an impulsive movement in the minor degree, and this wave 3 should initially target 4.2% based on the Fibonacci projection. It could potentially surpass this level, but it is important to consider the initial target before making any assumptions about its future direction. However, in the long term, it suggests that yields will decrease once this whole impulsive move is completed. In summary, while the dollar is moving lower, the 10-year yields are moving in the opposite direction. A similar situation can be observed with the 2-year Treasury yields, which are trading higher than the 10-year yields. At present, we are approaching wave 5 of a smaller degree, with an initial target of 5.3%. This movement should mark the completion of the entire corrective upward trend in yields, after which we can expect a decline. Alternatively, there is a possibility of consolidation and sideways movement. Nevertheless, the key point remains that the dollar is weakening while yields are increasing. Furthermore, as mentioned earlier regarding the potential ABCDE pattern, if the DXY dollar index rises in tandem with higher yields, it would be the least favorable outcome for stocks and cryptocurrencies. Hence, it is crucial to closely monitor the ongoing developments in the dollar and yields, as they hold significant implications. Now let's redirect our attention to the S&P 500 index. It's evident that we have been experiencing a significant bullish trend since October 13, 2022, resulting in an approximate gain of 27.46%. At present, we have completed the fourth wave of a smaller degree, finding support slightly above the 20-day moving average, and we are currently advancing towards the fifth wave. The crucial question remains: how far can we progress, and what potential resistance levels might we encounter? To answer this, we need to examine various Fibonacci projection levels. By projecting from wave D to wave A and wave B, the Fibonacci target indicates 4,450, corresponding to the 100% projection level. It seems that we encountered some resistance at this level during Friday's session. If we surpass the 4,540 mark, our focus should shift toward the Fibonacci projection level of wave E, which suggests a target of approximately 4,450. This target also aligns with the Fibonacci projections from Wave 2, Wave 3, and Wave 4. Taking a broader view, one could argue that the entire upward movement from the October 2022 lows is a corrective pattern. This implies that what we are witnessing is an ABCDE pattern, possibly part of a larger-scale Wave B. It's important to maintain an open mind and not let the corrective nature of the move prevent you from capitalizing on any upward movements. Let's examine what the technical indicators indicate. As you can observe, the intraday charts show an overbought condition in the Relative Strength Index, RSI. The daily RSI is also overbought, and the weekly RSI is approaching overbought levels as well. The MACD signals across the board still indicate a buy, but we should be aware that Wave 5 could continue to rise while the RSI levels decline. This would result in a negative divergence in the RSI, confirming the presence of Wave 5. Shifting back to the daily chart, we can see that the Bollinger Bands are indicating an overbought condition. Thus, there is a possibility of a pullback, especially considering the open gap left during Friday's session. Let's apply some moving averages to understand the market trend better. The 50-day moving average is ascending and catching up, while the 200-day moving average is gaining momentum. If we experience a substantial pullback from current levels, this Wave 4 correction could be part of an ABC or ABCDE pattern, which typically takes longer to unfold. Such a scenario would also provide an opportunity for the moving averages to catch up to the current price levels. When drawing a Fibonacci retracement, it is typically desirable for Wave 4 to conclude around either the 0.236 or 0.382 levels. Let's shift our focus to the Nasdaq 100 and assess the technical aspects. We observe a similar pattern here, with Wave 4 finding support at the 0.236 Fibonacci retracement level. However, we mustn't disregard the possibility that this upward movement is part of Wave B. There is a risk of another downward leg to complete Wave C. Considering our current position, Wave 5 is still unfolding, and several target levels seem to align with each other. Wave C is expected to conclude around 15,480, Wave E around 15,865, and Wave 5 around 16,270. Whichever target encounters resistance, the bullish trend remains intact, suggesting a potential further 3 to 8% upward move from current levels. If Wave 4 is not yet completed, we would need to redraw the Fibonacci levels, which would affect the target levels. Applying the Bollinger Bands, we observe that Wave 4 coincided with the 20-day moving average, and the confirmation of significant demand came from the open gap at that level. Let's also consider the key moving averages. One concern is that the Nasdaq 100 has become excessively extended above the 200-day and 50-day moving averages. This suggests a pullback could be imminent. However, as Wave 5 is still in progress, we maintain a bullish stance, and there is no need to sell at current levels, even if a pullback occurs. In fact, it could present a buying opportunity for those looking to capitalize on the final leg up towards Wave 5. Let's shift our attention to the Russell 2000. On May 17th, the Russell 2000 broke out of a descending lower high trend line, signaling a positive development. We have maintained a bullish stance and utilized the pullback from Wave 1 to add to our long positions. Currently, it appears that we have completed Wave 3 of intermediate degree and are now advancing towards Wave 5. Wave 4 found support at the 0.236 Fibonacci retracement level, prompting us to increase our long positions at that level. The initial target for Wave 5 is 1950, but there is potential for it to extend as far as 2034. Monitoring the short-term wave levels will provide us with a clearer outlook on where Wave 5 might conclude. Presently, the Russell 2000 remains a strong buy, and any pullbacks could present attractive buying opportunities. However, from a long-term perspective, it is important to consider the possibility of this structure being an ABCDE pattern. Zooming out provides a broader context for this view. Nonetheless, this should not deter us from capitalizing on the current rally. We must exercise caution, as a significant pullback may be in the cards over the long term. By analyzing the key moving averages, we observe that we are not excessively extended above the 200-day or 50-day moving averages. In fact, there is potential for a bullish crossover where the 50-day moving average rises above the 200-day moving average in the near future. Thank you for staying engaged and deepening your understanding of the current state of the dollar, yields, and market indexes. As we look ahead to the coming week, it is important to brace ourselves for potential market volatility due to a significant influx of economic data. Kicking off the truncated week, All eyes will be on the eagerly anticipated release of the Institute for Supply Management's Manufacturing Survey Index on Monday at 10 a.m. This index, a key barometer of economic activity, is expected to hover below the crucial 50 level, signifying a contraction in overall industrial activity. Then, on Wednesday at 2 p.m., market participants will eagerly analyze the release of the minutes from the Federal Reserve's June 13th, 14 meeting. These minutes hold the potential to offer valuable insights into the reasoning behind policymakers' projections of 2 additional rate hikes, a topic of great interest and significance to investors and market participants. Once again, I extend my gratitude for your viewership. Don't forget to show your support by liking and subscribing to this channel. For daily updates, you can also follow us on Twitter at Nomadhedge.